we were representing the bank, and on the other side was a extremely smart, contracting savvy tech founder, his extremely smart, contracting savvy general counsel, and the head of the technology practice of one of India's oldest law firms. During the negotiations, it was very clear that for that startup, it was the first time negotiating with a bank, and with a bank of our bank size. It was very clear that neither them nor the other lawyers involved in it were familiar with the contractual guardrails that govern contracting, including in tech with the bank. And so Ankita and I scratched our heads and said, no, this is not just about fintech. This is even more specialized in fintech. And so we formed a team called Technology in Banking then. This is the first presentation that comes out of that team. Soumitra, an associate, an integral part of that team. In fact, I think Soumitra now works 95% of its time on banking contracts, ranging from open banking to commercial contracts and outsourcing and software development and embedded finance and strategic partnerships and server maintenance and cybersecurity contracts. About 60%, Soumitra, correct me if I'm wrong, for the banks, and about 40% for the service providers. Would that be accurate, Soumitra?
Yeah, that's right.
Yeah. So that's the entire team. Soumitra has 5 other colleagues in the team who do only this kind of work. So very specialized, and the contractual matrix, the negotiations, all of that are also very, very specialized. So in the course of this presentation, what we'll do is we'll tell you what the contractual matrix governing these kind of contracts are. We'll tell you what we see are the pain points from the bank side, and we'll tell you what are the pain points from the startup side. We won't tell you what the solutions are, because that depends on a case-to-case basis on the negotiating part of the bank, on the negotiating part of the tech service provider, on standard practices, markets, etc. So each time that varies. But we can take you through what each side's positions are, and we can even throw open the floor to see if any one of you have differing experiences when you negotiate with banks. For example, how do banks negotiate their cybersecurity requirements? How do banks negotiate their indemnity and liability clauses? How do banks negotiate their regulatory audit clauses? How do startups negotiate back? How do we protect your IP when you do that? That entire spectrum, I hope, is going to be a little bit more of a dialogue. So I think the way Soumitra structured this presentation is that the first part is the law, and the second part is the more fun stuff, which is how do we negotiate X and Y, and what do we get away with, and what do we not get away with, and what are the bank's primary concerns. We're not, remember, going to take a judgment on this, because each bank and regulated entity has their own way of dealing with these sorts of risks. But there is a RBI guideline dating back many, many years that lays the foundation for this. There are multiple master directives that have come in after that, and then we'll take you to the new law that came in last year, so that you have an idea of the law, you have an idea of the negotiating strategy, and at the end of it, worst comes to worst, you know that there are 100 other companies and other banks who are struggling with making commercial solutions that comply with the guardrails and yet are sophisticated enough to deal with evolving technology. With that, Soumitra, do you want to take it away?
Yep.
Or Ankita, do you want to jump in?
Soumitra can take up.
Okay, perfect.
Right. So fundamentally, we should address this. What exactly is outsourcing? So outsourcing is when a bank or a regulated entity essentially uses a third party to perform activities on a continuous basis that would normally be undertaken by the regulated entity itself. This can either be now or in the future. And here, continuing basis does not mean it's for an unlimited term. Even agreements that are for a limited term are covered within the ambit of the term continuing basis. And third parties would cover parties that are not just parties in the group entity of the regulated entity, but could also include other third parties as well. Can we go on to the next slide? So what exactly is IT outsourcing? So given the evolving ecosystem, we are witnessing extensive outsourcing of critical information technology services by banks generally, which helps them get access to newer technologies to vendors, and it improves the efficiencies and the customer experience. The customers have a lot of dependence on the digital channels to avail banking services. And given that it may not always be feasible to develop the tech in-house, banks usually, or even other regulated entities, outsource these IT services. Given that banks are generally exposed to significant financial and operational risks in their regular course of business, it is imperative for them to also ensure that the vendors that they partner with also focus on their operational resilience. The bank ought to ideally have a risk management framework for their IT outsourcing. And the Reserve Bank has issued guidelines on April 10th, 2023 this year that help the banks and other regulated entities come up with this framework. Now, these master directions basically apply to all banking companies, corresponding new banks, State Bank of India, primary cooperative banks, NBFCs, credit information companies. Then there's the Exim Bank, then there's NABARD, then there's the National Bank for Financing Infrastructure and Development, the NHB, and the Small Industries Development Bank of India. This is also applicable to foreign banks that are operating in India through the branch mode.
Just one quick thing to add in there, which is very interesting to note, is the RBI, of course, has been cognizant about the dependence on IT services for the regulated sector. These IT directions came in when there was extensive reliance on third parties, especially for AI, ML, analytics, and the core software and the products that the banks and regulated entities were adopting. What's interesting to note is while this circular extends to banks, NBFCs, even credit bureau entities, it does not extend to payment system operators. And the outsourcing guidelines for payment system operator clearly excludes the ability to outsource IT and security management. So that's a very interesting differentiation to note. The RBI is, of course, very carefully evaluating what sort of outsourcing, even in the IT framework, ought to be permissible, who should be allowed to undertake it, and absolutely putting down stringent mechanisms on how this should be evaluated. The kind of compliances that are now expected out of all these regulated entities are multifold, not only just contractual, but internal from a compliance processes perspective, as well as constant diligence. And of course, we'll deep dive into that in a bit.
Right. Now, in the master directions, they've already factored in the existing agreements that the bank may have, and they've granted some times for the bank to accordingly ensure that these master directions are flown down. For agreements that are due for renewal before 1st October 23, the provisions of these directions shall have to be incorporated in the renewal, preferably on the renewal date, but in like any scenario, no later than 12 months from 10th April 2023. For agreements that are due for renewal on or after the 1st of October 2023, RBI has again said that this should either be done on the renewal date or 36 months from 1st April 2023. But in this case, they've given a carve out that whichever is earlier amongst these two dates, that should be the operative date. And for the new outsourcing arrangements that will be entered into, for agreements that shall come into force before October 1st, 2023, again, they'll have to comply with the provisions of these directions on the effective date. But in any event, if that's not possible, within 12 months from 10th April 2023. And for any agreement that comes into force on or after October 1st this year, shall have to comply with the provisions of these directions from the effective date itself. Now we go into the question of what exactly is IT outsourcing. And the master directions have given a pretty wide definition. It includes everything from IT infrastructure management, maintenance and support for that, network security solutions, application development, services operations related to data centers, etc. And one more thing that's important is that these master directions apply only to the material outsourcing of IT services. And this has been specified as like if a service is disrupted or compromised, that shall have the potential to significantly impact the bank's business operations, or it may have a material impact on the bank's customers in the event of any unauthorized access, loss, or theft of customer information. Given that, there is also a list of exceptions that the RBI has carved out in Appendix 3, And it may be relevant for us to kind of see a few examples of the activities that would be governed by these master directions and a few that would be excluded from the ambit of these outsourcing directions. So the first one, if we see managed security services, so this essentially a managed security service provider would provide outsource monitoring and management of security systems and devices. Common examples include managed firewall, intrusion detection, some virtual private network, vulnerability scanning, and antiviral services. Then we go to cloud computing, which essentially is the delivery of computing services that includes servers, storage, databases, analytics, and this is offered over the internet. Then we go to network management. These are network applications, functions, and services that enterprises or like entities outsource to be remotely operated or monitored and maintained by a managed service provider. For examples of this could be user administration, implementing upgrades, monthly status reporting, etc. And the last example is that of an application development, which essentially includes any software development that a vendor does for a bank, the design for it, any implementation, integration, testing, etc. After that, we'll go to the products which are not within the scope of the IT outsourcing master directions. We talk about the data validation and verification services. So these services essentially allow you to verify customers' identity documents in real time and allows you to onboard users. This is excluded. And then general procurement of IT hardware or appliances, like these are equipments that are required to support the bank's operations. Other than that, platforms provided by entities like Reuters, Bloomberg, etc. are also excluded. And any consultants that are appointed by banks for VAPT or audit or any certifications, those activities are excluded from the ambit of outsourcing.
Another quick point to just add in here with respect to activities that are not covered. As Soumitra mentioned, these guidelines apply to material outsourcing, which means every regulated entity that's governed by these directions will have to firstly put in a mechanism to evaluate materiality. The second is based on those kind of contracts and those kind of arrangements, it will have to put in these processes as per the guidelines. Now, there are products and tech arrangements that do not fall directly within this ambit, and that may not be material. However, with the increased dependency on these third parties, and the kind of scrutiny RBI has and other regulators have in respect of data storage, cybersecurity, the certain guidelines, it becomes very important for all regulated entities to closely evaluate that even in arrangements that do not directly fall under these guidelines, to what extent certain parameters and clauses must be imposed. For example, something as basic as data localization, the guidelines impose it. It's the financial sector. We've seen this as an increasing concern in this sector. Different regulations require data to be localized in India, especially when it comes to the financial sector, like payments data. So would a bank take a policy position to ensure that any party it partners with from a tech services purpose, ought to store data in India? If not, would you try and impose similar parameters and policies in terms of exporting it, processing it, and bringing it back to India? So these are aspects that will have to be evaluated given the new law. And need to be done on a case-to-case basis, depending upon how important the arrangement is, what kind of data a particular service provider will be accessing, and the nature of service, of course.
Right. Ruchika, if we can go on to the next slide. So one of the important questions that we regularly get asked is whether a SaaS license, whether it would be considered as an outsourced activity or not under the master directions. So again, SaaS would basically be that the software is hosted on some remote server and is maintained and updated by the service provider. It's usually made available to its customers via web browsers, mobile applications, or APIs. As the software is usually hosted on the service provider's servers, there is no need for users to invest in essentially expensive infrastructure to use the software. Usually, the users will just pay a subscription fee to access this software as an on-demand service. Some examples that we can consider are Outlook, Slack, Salesforce, products, etc. Now, the RBI has specifically excluded these from the outsourcing aspects from the master directions. Some examples are acquisition of IT software or product or an application on a license or a subscription basis, and any enhancements made to such licensed third-party application by its vendor or on specific change requests. any maintenance service for any IT infra or licensed products, or any other off-the-shelf products, where there is only a minimal customization or no customization. But there is another type of licensing that we've considered, which is called as an application service provider. This would essentially mean a customized solution that is provided to the customer. It can either be hosted by a third party or hosted on-prem by the actual user. And this actually would be governed by the ambit of these IT master directions.
Just to quickly add in here as well, right? The application service provider concept, the RBI, of course, does not delve into the nature of what these application service providers undertake and whether every SaaS arrangement would be deemed as an application service provider arrangement. However, the moment there is involvement by a service provider that is directly linked with the regulated entity's business, it's curated for the business, it's specific to that regulated entity, it may be a SaaS solution that is deployed on-prem, it would be in the nature of an application service provider as opposed to a pure play SaaS arrangement. Right? A pure play SaaS would be a Zoom subscription, would be a Workday subscription for employee management, would be an HR tools, Microsoft. Those would be the usual off-the-shelf SaaS arrangements. But the moment the products and the services that a regulated entity is availing are slightly more nuanced, if it is analytics or financial information, if it is a loan management service, loan management product or a tool that is being used by an NBFC, a loan origination system, right? The moment these products start being licensed or subscribed to as a SaaS product, we need to very closely evaluate whether this is a pure play SaaS or is it in the nature of an application service provider. So there's a very thin line of difference that needs to be closely evaluated to see whether it will fall within the outsourcing or fall out of the outsourcing regime.
Yeah, if we go on to the next slide, we can talk about the use of artificial intelligence in banking.
Yep, and quite timely, as I think the RBI has just selected a couple of service providers to improve regulatory supervision using AI and ML. So, and I don't want to take names, but we have some very rich consultants in the country today. But very quickly, as all of you probably realized, there's a lot of AI use in banking, and a lot of it is customer centricity because you can have specializations using AI, chatbots enabled using AI, etc. You're obviously looking at increased productivity. Even within a law firm, when we use AI, we see a huge hike in productivity. We also see a huge hike in silly sentences that ought not to be there in contracts, but we'll take it, that time will solve, hopefully. It, of course, data-driven, it leads to more informed data-driven decision-making, and it is very, very useful in detecting fraudulent activities. In fact, two of our largest fraud management companies both extensively rely on AI, and in fact, their entire confidentiality process, etc., revolves around the use of artificial intelligence. That's a broad framework. Next page, something. Where does AI normally use? It's used in chatbots, it's used in predictive and analytics, it's used in credit underwriting, it's used in risk management, it's used in portfolio management. All of you know this. Now, there are no RBI special regulations on artificial intelligence, although we think it's probably time to start very seriously thinking about it. Given that, regardless, what is the contractual, legal, and commercial negotiating points that come up when using AI? So let's assume hypothetically that Soumitra is the founder of a AI-driven bank product that banks can use to, let's say, do predictive analytics. Right? Let's say Ankita is the bank's lawyer and I am the service provider's lawyer. Right? What are the interests that Ankita has to protect? One is obviously is the engine, the database and the engine, the analysis engine, are they structured in a manner that is consistent with the RBI cybersecurity and data protection regulations, right? i.e., does the AI get access to data? Does the AI then does the people behind the AI have the ability to access that data? Does the AI use that data in manners that are not permissible according to the RBI? And does the data also then kind of fall afoul of localization. Is the engine based in India? All of that kind of nonsense. So that's one. That is the broad regulatory perspective from which banks will look at it. But from the other angle that the banks ought to be looking at it, although I'm not very consistent, I'm not very confident that they do it as often as they should, is a service provider using this data going to have a competitive edge, and is he going to sell that edge to the banks, competing banks? That's the second thing. Slowly our banking clients are evaluating it, so that both of these considerations convert into contractual clauses, very different from both sides, but also convert into huge fights between bank council and service provider council. I can tell you that the last time I did a major banking contract about 4 months ago, we spent 1.5 weeks arguing on observability, telemetry, and unique instances and unlearning. Now, those are the four legal constructs that kind of surround a artificial intelligence engine being used in the context of a bank. What does it say? Telemetry and observability are one class of analysis that can happen, whereby, let's say, the service provider's engine can watch exactly what is happening within the bank systems, can observe it with necessary data protection and cybersecurity protocols, can observe it and can learn from the observation, right? These are the kind of people who do these kind of fraud. This is the periodicity of fraud. This is all of that, right? This is what to do that gives the best results in terms of managing fraud. All of that an engine can learn using telemetry and observability. That's one. Can that then be transferred to other competitors in similar places, and will the same observations apply there? And then can we avoid detailed algorithms so that I can give one standard set of observations in respect of banking practices in India, right? Flip it the other way around. What will the bank say? The bank will say, you will have to create a specific instance of an artificial intelligence engine for me. You will probably have to place it within my premises, even though I won't have access to it. And you will have to ensure that that learning that instance has will not be shared with 1, 2, 3, 4, 5, whatever they may be, either an exhaustive list of companies or a kind of companies or other banks or other financial services, all of that. The other solution that exists within the market is to say, yes, using mine, you may learn 10 things, but at the end of the contract, you've got to unlearn 10 things. Now, there are technological debates as to how to do it. So best efforts to unlearn it, absolutely unlearn it, commercially reasonable efforts to unlearn it. What is commercially reasonable? What is best efforts? These are the debates you'll see within artificial intelligence, which all of you have to necessarily engage with. In fact, at this point, good time to stop and say we will have the next session on artificial intelligence in banking, where we'll tell you contractually how you can play around with these constructs so as to, one, protect yourself from any harm if you are, let's say, a regulated entity, or to ensure that you give customer comfort that there is no downside to the use of artificial intelligence, but at the same side, ensure that you get the upside of the observations that you've got going for you. So both of those are possible. Both of those are contractual sessions, which will take a good 1 hour to take you through. So we're going to skip over those. We're going to come back to it in a couple of weeks. So if anyone wants to attend, drop us an email. We'll be happy to keep you in check and send you an email when we have dates for that. But all of you need to very, very seriously think of what is your firm's position on the use of artificial intelligence. If you are the service provider, what are the contractual guardrails that you have in place? Similarly, if you're a bank or a regulated entity, what are the contractual guardrails you have in place when your service provider is using artificial intelligence? Are we comfortable with, and some banks have taken the position that they are comfortable with de-identified learnings, metadata being used for learnings for an artificial intelligence engine. In fact, we just closed a tripartite, Samitra, in fact, the three of us and Adya, four of us have just closed a very large contractual joint venture, not an incorporated joint venture, but an unincorporated joint venture between one American entity, one Dutch entity, and a German entity on, amongst other things, sharing of data in lending, and the learnings that will happen and who will observe and where will the learnings happen, and the thorny question of what will you do when the JV, which is time bound, ends, right? So again, encourage you guys to keep thinking about it, evaluate your processes prior to getting into a negotiation. Do not get into a negotiation. So the one thing we've learned is if you get into that negotiation without your contractual ends in mind, you could end up for 1 or 2 months just debating what's reasonable vis-a-vis artificial intelligence. You need to have a position internally. You need to have it identified with your bank so that the whole question of AI is sorted. You need to get into an engagement with external counsel if required prior to any particular transaction to say, how should we think about AI, right? What does the regulator say? What does the market say? What should be our position? And how are we going to negotiate to get to that position? As always, Samitra is nodding at me and sending me messages saying, Matthew, you're taking too long. So we'll move on from AI, because we'll be dealing with it more comprehensively. Please go on, Samitra.
Yeah.
But that said, before Samitra goes on, if anyone has any questions, please feel free to raise your hand and we'll have you on the session. Okay, I guess not. Let's go on, Samitra.
Yeah. So usually before any IT service is outsourced by a regulated entity, there have to be certain obligations that the regulated entity has to comply with. Primarily, they have to consider the risks and benefits that are associated with the outsourcing activity. The regulated entity is essentially required to determine the criticality of the activity that is going to be outsourced, the expectations and the outcome that will arise from this outsourcing, the success factors and the cost benefit analysis with respect to this outsourcing activity, and decide the model for this outsourcing. We've observed that regulated entities typically ought to ensure that this outsourcing does not reduce the stringency of the regulated entity's obligations. The regulated entity is required to hold the service providers to the same standard as it hold itself. The grievance redressal mechanism of the regulated entity should not be impacted in any manner. The customer's redressal in that sense should not be affected just because the activity has been outsourced. Generally, regulated entities should avoid engaging with service providers that would compromise or weaken the RE's reputation. A usual inventory of the services that have been outsourced, including the key point of contacts of all the service providers, should be maintained by the REs. Again, the activity that has been outsourced should not interfere with any of the regulated entities' rights or impede in the RBI's supervisory role either. And lastly, if the service provider is not a group company, the regulated entity has to ensure, like purely from a legal perspective, that the service provider is not owned or controlled by a director, a key managerial personnel, any approver of the outsourcing arrangement, or their relative. There is an exception to this rule where the board of the regulated entity can essentially analyze and assess the outsourcing requirement and give its approval for that. But yeah, usually this doesn't happen. If we move on to the next slide, yeah. So in terms of due diligence, the regulated entity has to ensure that all laws, regulations, guidelines, or any licenses or registrations that would be required, that would be applicable to this particular engagement, would have to be flown down and accepted by the service provider in the agreement. Usually there have to be from both ends a risk evaluation. The parties have to analyze what qualitative, financial, operational risks that are there, and the RE then usually also conducts a due diligence on the potential service provider. And there are certain parameters that we have observed here. For example, an activity that is outsourced, an RE will usually think of in terms of a cybersecurity compliance. the service provider's compliance should at least be equivalent to that of the bank. Then other aspects such as the bank's information should not be commingled with any other party's information in anywhere. The service provider's employees should also have robust confidentiality agreements to ensure that the confidentiality is maintained. And other aspects also include like BCP and DRs that the service provider has. Those should at least generally be equal to, or like, if not even at least better than what the regulated entities have in place right now.
So if I could just jump in, that's the big negotiating argument, right? Because you're a tech service provider, you probably do not have the money or the infrastructure to set up the kind of processes that, say, a bank or a large lender or even a large insurer has. Unfortunately, the regulator requires the banks to enforce 10 things. So what you need to do is you need to have identified those 10 things as a service provider. You need to have figured out which of those 10 things are relevant to you, because some of them may not be relevant to you. You need to then figure out what the scope of those requirements are and make sure that you only agree to the minimum scope that is required. If there is a ask for a maximum scope, then you kind of need to put the regulated entity on the mat, so to speak, and ask them to commercially justify excessive requirements, right? Let's say audits every 3 months. Does the RBI require to do that? No. Then why are you forcing me to do it, right? For which you need to know how many audits the RBI requires you to do in a year and how thoroughly and what they are and all of that. Anyway, go on.
Yeah. So to also ensure this compliance from the regulated entity's perspective, it ought to have a outsourcing policy that is in place. The board and the senior management need to have certain obligations that they need to adhere to. The risk management framework and policies that have been developed have to continually ensure that they are relevant. Like if there is any new change in law or any new practical difficulty that they're facing, the policies accordingly need to be updated. They have to decide on what activities are essentially going to be outsourced based on the risk and the materiality, and also lay down a practical framework of senior management for the purpose of these directions. The other aspects that they need to also ensure is that the board and the senior management need to monitor and manage risks as they arise and need to report them as well to the senior management again. There has to be like, an organization has to be skilled enough to ensure that there is proper oversight and monitoring on any activity that essentially is outsourced. If you can go on to the next slide, Ruchma. Right. So risk management and the IT function. So risk management, for that, essentially there has to be a risk management framework that is put in place that we just discussed. It has to deal with the processes and the responsibilities that are associated with the IT services. That includes identification, measurement, mitigation, management, and reporting of the risk. It also should cover risk assessments that have been carried out. Those ought to be reasonably and successfully documented with the necessary approvals in line. These risk assessments are required to be made subject to internal and external quality assurance and on a periodic basis. And this is to be conducted in line with the board approved policy that is in place. There have to be measures that are imposed to ensure the confidentiality and security of the customer data. Essentially, the regulated entity will be held responsible if there is any breach of confidentiality or security of any customer data or information. The regulated entity ought to ensure that this data or information is preserved and like securely protected as well while it is in the possession of the service provider. And they should also ensure that the service provider, if any staff of the service provider is going to have access to this data, that should only be on a need to know basis. In terms of the, if you can go back, Ruchika, to the earlier slide. Yeah, in terms of the security breaches, the reporting requirements, the outsourcing directions stipulate that the service provider is required to report to the RE without undue delay in the event of any security incident. And thereafter, the regulated entity is required to report to the RBI within 6 hours of detection by the service provider. If there are any incident management guidelines or incident response and recovery management guidelines that the RBI has come up with, the REs have to ensure that they adhere to that and flow these down to the service providers as well. In case the REs are required, like the staff members of the service providers are required to access data at the REs locations or data centers, this has to be on a need to know basis, and appropriate controls have to be kind of implemented by the RE. If you go on to the next slide. So there are multiple instances where multiple service provider relationships are required to avail one service. In that particular instance, the bank or an RE will have to be responsible to monitor and control the environment of all such service providers, because these service providers will have access to the customer's data, systems, records, resources, and the data that the RE has as well. Then we also need to factor in where a single service provider acts as an outsourced agent for multiple regulated REs. Now we have to ensure that there are adequate safeguards that are built in to ensure that there is no combining of information or documents or assets of any RE. And lastly, we need to evaluate the risk concentration as well. If there is multiple outsourced activities that are being outsourced to the same service provider, then the regulated entity ought to effectively assess the impact of this concentration risk. RBI, however, right now has no prescribed thresholds in this regard, but the REs ought to keep this in mind. Now for the BCP and DR, again, the REs have to ensure that the service providers develop and have a robust framework for like documenting, maintaining, and testing the business continuity plan as well as the disaster recovery plan that is commensurate with the nature and scope of the outsourced activity. It essentially has to be the same as what the bank would have had in place. There also ought to be a contingency plan where the RE is required to consider the availability of an alternate service provider and also consider the possibility of bringing the service back in-house if it's not possible to identify an alternate service provider. If we then go to the exit strategy that the regulated entities need to have, any agreement that is covered under the ambit of this IT outsourcing needs to have a clear exit strategy that factors in all the different scenarios where a service provider or the regulated entity may exit. There has to be a legal obligation that is imposed on the service provider that the transition would be smooth. Certain clauses that are mandatory in this aspect are the removal or destruction of any confidential information, data, etc. The service provider has to adhere to the bank's internal policies as well. And if there is a period that can be agreed between both the parties where the services will continue to be rendered till either the bank moves in-house with its services or appoints another service provider. So all of this needs to be factored in the agreement that the bank has with the service provider.
Just to quickly add to that, especially with respect to the exit strategy, and Matthew, feel free to chime in. We've had in the past, while negotiating fairly large contracts for regulated entities, always come to a roadblock when it came to transition planning. And while, of course, it's a sticky point from a legal perspective because everything needs to tie into how the regulated entity would continue business, even from the business team's perspective, to envisage a situation where they would have to stop relying on the service provider is something that they need to start planning for at the time of selecting the particular service provider and not just contracting. And very often the parties would leave this exit strategy to 1 year down the line, or to mutually come to a plan if the termination takes place. That approach, I don't think, would work any longer. Now, when banks are entering into material contracts, exit strategy becomes the first and the foremost important thing that will have to be evaluated very, very closely. Escrow, of course, is just one small example which a lot of players did put in place for specific arrangements, but that was primarily if the service provider or the software provider goes bankrupt. But in these instances, to plan out an efficient exit strategy to make sure it does not impact the bank, it will have to go way over and above just an escrow arrangement. Go ahead, Samitra, please.
Yeah. Moving on to offshore service providers, like these are service providers that are located outside India. Again, certain aspects have to be considered. Again, those, like basically any entity that is entering into such sort of an arrangement should typically factor in the political, economic, social factors in the country where the service provider is located, And this ought to be continually assessed, given that the scenario may change from time to time. We've observed, like we've had like luckily the chance to negotiate for both service providers and banks with respect to offshore agreements. We have to ensure that there are risk mitigation procedures that have been built in. And one other important aspect is that the RBI's rights in any way should not be affected, regardless of where the service provider is located. One other thing that we've seen is usually the service provider then ought to be located in a jurisdiction which upholds confidentiality, data privacy, all of these obligations as well. And generally, we have to ensure that all the obligations, the statutory as well as any other obligation that is just imposed on the RE by the RBI, have to be contractually flown down to the service provider that is based out of India as well. And now if we consider the service providers that are part of the same group companies, essentially these have to be undertaken at an arm's length from the group entities. And the other aspect is any obligation that we impose on any other regular service provider, the same obligations ought to then be imposed on the service provider who's part of your group as well. There's no exception as such to that. If we can go on. Yeah. So generally from a contractual framework, while there are multiple clauses that ought to be a part of the agreement that the RE and the service provider has, some of them include like the scope of services, like it needs to be carefully drafted. What services have exactly been outsourced, what are the deliverables, the SLAs that are associated with the services, performance standards of any subcontractors. We also have to ensure that the supervision by the RE and the RBI is carefully captured in the agreement. We should not try to we should make sure that while it's a balanced arrangement, whatever is statutorily available to either the regulated entity or the RBI should be covered in the agreement. Confidentiality, again, the events of security breach and leak of any confidential information should essentially be reported to the RE. There needs to be enough contractual protection that a regulated entity has when it considers the confidentiality of the information it has shared with the service provider. Similarly with data protection as well. The data usually should be stored in India under the existing regulatory requirements. They have to adhere to the restrictions on the type of data that the service provider may share with the RE's customers or any third party, and general compliance with earlier it was the IT Act, and now with the new bill in play with that as well. The RE has to ensure that the service provider has robust BCP DRs in place. The last thing is there need to be clauses that safeguard against the service provider's obligation with respect to its subcontractors or third parties it partners with. Essentially, if the service provider is appointing or using any third party, then it has to contractually take up the responsibility for that third party or contractor that it is partnered with. So these are some of the aspects that ought to be covered in the contractual framework between a regulated entity and the service provider. We'll move on to a few of the practical hurdles that we've seen when we negotiate these agreements. Now, when we talk about access to records, one major problem is that we've seen startups don't really have the appropriate controls in place to adhere to all the obligations or compliances that are required under the IT outsourcing directions. Now, like Matthew mentioned, we need to evaluate this from a, for every case, whatever is specifically relevant for a regulated entity, the startup that's partnering with it will have to, in some shape or form, agree to that. Then we move on to audit and inspection. So while audit rights, again, are mandated under the outsourcing directions, we've seen typically like the regulated entities would want a right to audit and inspect anything and everything that is related to the services, whereas the service providers would want to restrict the scope. They will want to protect the IP from being accessed by the service provider. They would want to ensure that an audit is always conducted with a prior written notice. The number of times an audit is conducted within 1 calendar year, etc. So all of these factors will have to be considered. For data privacy, again, the controls for maintaining data privacy are a point of concern, because a lot of times we've seen the service providers facing a lot of practical difficulties to implement these controls in place. again, we'll have to factor in the DPDPA too here. We'll have to, one of the most highly negotiated points that we've come across in agreements is with respect to breach of data. So both the sides, like the regulated entity and the service provider, ought to consider the value of the contract. Like if it's a high value contract, then the liability caps for that essentially should be either uncapped or have a super cap of some sort. If it's a medium value contract, then we can arrive at a value that's agreeable to both parties, again, in terms of a data breach for a liability cap. And again, for a low value contract, we can take that call for a case-to-case basis and arrive at a conclusion at that point of time. When we talk about the BCP and the DR, the standards that a regulated entity expects from its service providers are not often practically feasible for the startups to have in place. It's not possible every time to match a regulated entity's exception. But I would like to say that like not having a BCP is essentially a recipe for disaster. And again, startups or service providers may consider factoring in or procuring some sort of an insurance that covers itself from this sort of a liability. And the last,
if I could just jump in very quickly, all of these are points of tension in the arrangement, depending on how large the service provider is and how large the regulated entity is as well. So none of these are prescriptions. Each one of these would have to be evaluated vis-a-vis the deal at hand. If I'm doing a $300 million deal, bloody go and get me my insurance and get me the best standards for BCP, data protection, get me audits and inspection. If I'm doing a 50 lakh deal, basic, I don't know, moat building around security, perhaps some of these are unreasonable requests. Regardless, what is statutorily required will have to be incorporated into agreements, and the rest you'll have to find a way to reach a settlement between obviously the regulated entities' desire to impose as many protective clauses and obligations as possible, and the service provider's requirement to be as nimble as possible. But that said, don't look at these as prescriptions. In fact, we have another session coming in at a slightly later date where we track market trends in banking contracts of this sort. We will tell you on BCP what are the 3 most common clauses we've seen. But all of these, I just want to caution you to being prescriptive about this. All of these are subject to business negotiations. Let's move on, SP.
Yeah, and the last point that we have is the subcontracting aspect. Now, again, this is where we see a lot of negotiations happening between the regulated entities and the service providers. The regulated entities want to ensure that any subcontractor that is appointed by a service provider is appointed after the RE gives its prior consent or approval. But for the service providers, in most cases, it's not practically possible to take each RE's consent that they've partnered with before appointing any subcontractor. So this again is a heavily negotiated point, and we have to somehow ensure that both the parties are satisfied at the end of the day. While the service provider's business is not hampered, the RE also should be able to adhere to its regulatory obligations as well. I think with that, if you go on to the next slide, Ruchika. Yeah, I think, we can open this up to any questions that anyone has.
Everyone's shy today. I must say that this is the quietest that an audience has been in any one of our sessions. I don't know if we've grown boring as we grow old. But anyway, it looks like there are no... Okay, DJ has a question. Go on, DJ. Ishita Kaku, would you give DJ the right to speak, please?
Yeah, am I audible?
Yep, sir. Tell us.
Yeah, so my question was on the last aspect of, we also face that issue where consent of the client or the bank has to be taken in case we appoint a service provider. Now, for global entities like us, maybe service provider is already there, or, you don't want to go to every client to seek consent. So would a workable solution, like if we give a list of service providers at a periodic interval, say quarterly or annually, and the client may object to a particular service provider, if that be, would that be a workable solution which would also be compliant?
Ankita, you want to take this or should I?
Yeah. So, DJ, this is the subcontracting bit, right? If I heard you right.
That's right. That's right.
Yeah. So, so DJ, the concern with subcontracting is that
Okay,
the
Ankita, let me step in.
yes.
So yeah, so I think a long list of subcontractors is permissible. A blacklist is permissible. Changes to that have to be also permissible. So there is a way of making it work with a list. It can be a long list. You might have to give jurisdictional locations depending on the bank that you're dealing with. But that is one way that can work. There are no RBI prescriptions that stop you from doing that. Does that help?
Yes. Yes. Thank you. Thank you. Madam.
But yeah, but I can also tell you that two of our bank clients would not agree to that, right? Because someone is asked and been politely declined, not for regulatory reasons, but for internal protocol and comfort reasons.
Got it. Thanks. Thanks.
Okay, I think we're all done unless someone else has any questions. And of course, if you have any questions, do reach out to Ankita, Samitra, or me, and we'd be happy to help you. Kind of navigate this. It's not as regulatory driven as it will continue to get over the years. So for now, you have more breathing room to do multiple things. Thank you. And on that note, please have a lovely weekend ahead. Bye-bye.